Hello and welcome to the macro for the end of the week that began on October the 2nd, 2017. This week was much bigger than I actually expected it to be, and the reason for it, you actually saw the RBA on Tuesday, and I won't go into it too much in this video because Tony and I did a fairly big video on Wednesday, and I think you should go and see it, but they clearly moved away from their slightly hawkish stance, basically shed their feathers even, to be dead neutral. What I really want to talk about today is actually something I don't always concentrate on that heavily because it's not as big an impactor on the markets as it can be, but clearly there is a lead out of it and a suggestion out of the retail sales that came out on Thursday that needs to be really delved into. So the chart that you can see on screen at the moment shows that in August we declined 0.6 of 1%. What you also can see from it is that they revised July down to a contraction of 0.2 of 1% as well. That is the worst 2-month read in almost 5 years. It's the worst monthly read in 4. But the main thing that I sort of took out of it is actually the conclusions they drew from behind it is that the consumption slowdown is happening in areas like takeaways, cafes, restaurants. Going out is where you saw a really big decline. There is also now most people are putting and talking about saving as a reasoning behind the reduction in consumption. You can also, therefore, the positive part out of it and stuff that we've been talking about for a while is that you actually did see that online sales continue to expand at double-digit rates. Isn't surprising, and therefore that Amazon disruption story you continue to hear about is justified, and I think that's clearly what's coming through. But what I really want to pick up is that the ABS's conclusions out of this is the expectation of rate rises, and that is what most people allude to as the reason why they are slowing down their consumption. Just the mere suggestion, and therefore the pressure that comes on household budgets is a reason that they've slowed down that side of the market, is going to therefore filter through into other things. I've spoken many times about GDP and what that means. The RBA has a GDP figure of 3% for 2018. It therefore would mean that net exports would have to do some serious heavy lifting along with the government. The government's already doing the lifting as it is, and that probably isn't necessarily a healthy thing on a long term. It also shows, therefore, that what the RBA did tell us on Tuesday, and the only bit I'd allude to, is that they are fully aware that household stress is a massive issue going forward and that they want to see some form of that filtering out before they can really move. Now, with that in mind, that's going to take a long time. And that's the conclusion, and why this week has been so much bigger than I expected, is that it therefore shows the RBA is probably out of the market for even longer than what I actually believe it could be. That the pressure on household budgets is clearly there even with rates not moving in any direction. And unless we see some form of change in possibly wages or in the outlook for the economy as a whole, filtering across the whole board, this pressure is going to filter through, and retail is going to be an absolute sort of microcosm of that kind of pressure. So what a week it has been, and therefore now retail sales going forward is going to be a gauge for how you look at 2018 and 19, from not just for spending, but also for your outlook in terms of consumption.
InvestSMART started in 1999 with one very simple idea, which was to help as many Australians as possible reach their financial goals. Today, we have over 620,000 members. We have 55,000 people using our portfolio manager. We have over 12,000 subscribers to our products and services. Our entire purpose is to help more Australians reach their financial goals with affordable services, products, and research.